Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com talks about the hit gold and silver took earlier in the week and how Canada's currency is holding up with panic hitting the Turkish lira. Author of the book The Money Bubble, John Rubino, takes a close look at how currency concerns can hit the banks and perhaps our personal bank accounts. He also examines the housing bubble and the constriction of credit. InsideTrackTrading.com President Eric Haddock digs into the cycles behind gold, interest rates, commodities, and crude oil. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back.
Good to be with you, Jim.
Ross, the gold and silver markets, I know silver took a pounding a few days ago. What's going on there and what do you expect?
Well, I mean, this all related back to a week ago with Turkey, and the catalyst there would be one that brought about a bit of a flight to quality, quite flight to safety, but we didn't get much of a bump as far as the gold and silver markets were concerned. The dollar index did very, very well, had a great run through the middle of this week. But the fact is that that run then meant that items priced in U.S. dollars, and that being gold and silver, the other metals, industrial metals also taking it on the nose. We got the copper market down into the 250s, took out that 272 to 270 support area. For what we see here in the gold and silver, they had some pretty good sell-offs. If we look back to early July, got good oversold readings, and the type of thing that should have been capable of producing a pretty good bounce. But we've talked about that 1232 area in gold as being a key resistance, and then moving down to 1219. And at this point now, having been down into the 1170s, I think we've got to be thinking that overhead resistance from 1205 up to 1230 is pretty important. Now, there's no doubt that these two markets are extremely oversold. You had daily sentiment readings on gold down to 6% bulls, so just way too many bears out there. And the probability is that there will be a good short covering rally, and we see that also when we look at the commitment of traders numbers. There's been a lot of discussion and analysis in the last couple of weeks about how the commercial positions are now getting to be one of the smallest shorts that we've seen in the last decade and a half, and likewise that you've got the speculators with one of the smallest net long positions. But that is all looked at in the context of what was a bull market from 2000 to 2011 in gold, and then this downside movement that we've had. We've given back $700 here, $1,900 down to $1,100, $1,200. So you would expect to see that as there's this unwinding of that multi-year bull market, that the specs would become more and more negative. Well, for all that this is a low number right now and should be capable of providing a decent rally, and we see that because the relative strength index and the Bollinger Bands are now at extended levels, and we should see the bounce. If we look back historically before 2000, you see that in that flat to bear market in gold, it dropped from 400 down to the 280 level over that 5-year period from 1995 to 2000. the speculators were net short all but about half a dozen weeks in that whole time frame. So it's not unusual for the speculators to be right on their positions for a period of time. So a bounce here, I think, is representative of what we should be looking for. But think about the 20-week or the 50-week as your key overhead levels for resistance. And just like in the bull market from 2000 to 2011, those same moving averages were support. So for now, anything in that 1230-ish range is probably the best that we're going to see on a decent bounce.
With Turkey having a currency crisis, is that going to spread, and should we be worried about the Canuck buck?
I don't know so much that you worry about Canada related to the U.S., but clearly the other currencies have taken it on the nose. We still sit here with negotiations regarding NAFTA, probably more important than just what's going on as far as Turkey is concerned with the U.S. And when I look at things like, say, the British pound or the euro, relative to the dollar index, they both are like the precious metals. They are overdone and look as though they're pretty ready for a pretty decent bounce. But these will be, once again, rallies and downtrends against a bottom line, a strong U.S. dollar. Dollar index had that good run that peaked out just in the middle of this week. But on the way up, we'd had a great run into overbought signals the end of May. We consolidated through the August the 8th. Only gave back about 30% of that really strong gain. Created what we saw as a nice little trough and a springboard, as our definition here, became a little bit oversold at the end of June and has had this breakout. So the dollar index, it's 96.5, probably has to hold 95 on a pullback, and I think it will hold 95.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up on This Week in Money, John Rubino.
Always consult your investment professional before making any investment decision.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Riaugh Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to This Week in Money, John.
Hey, Jim. Good to be back.
Taking a look at the past week, you did an article about a week ago about the commitment of traders when it came to gold. What's happened to that commitment?
Well, the Commitment of Traders report is a snapshot of what the guys who trade futures contracts in gold and silver are doing. And it's a pretty good indicator of the general tenor of the market and where it's probably going to go in the next 6 months or so. It's not a, tomorrow this is going to happen kind of trading signal, but it's a good general indicator of what's happening. And over the past 3 or 4 months, the speculators in the gold futures contract market, they tend to be wrong at major turning points because they trade on momentum and emotion. They started out very bullish, And as gold and silver have gone down the last few months, they've gotten progressively more bearish until they're just about as bearish as they've ever been, which is to say they're kind of neutral, because normally they're very long. So when they get neutral, in other words, their long positions and short positions balance out, that's a sign that they're at extreme bearish sentiment. And that usually precedes a run-up in the price of gold and silver. For instance, early January of 2016, we saw a signal similar to this, and then gold and silver just rocketed for 3 or 4 months. It had a really nice run. We're back there again in terms of the structure of the futures market. So that's a pretty positive thing for gold and silver. Now combine that with seasonality, which is the fact that Asians tend to do most of their gold buying, and they buy a ton of gold and a lot of silver towards the end of the year, because they like to give gold jewelry for wedding presents, and they have their weddings in the spring, and they like to stash their excess cash in precious metals, and they generate excess cash after the harvest, which is also late in the year and early in the new year. So there tends to be a lot of Asian gold buying and silver buying starting in August and running through January or February, and that usually pushes the price up. So we've got these two indicators both saying buy right now. In other words, the futures market is structured very bullishly, and seasonality is starting to move into the good times. So I think it's fairly safe to say that barring something really big happening out there, if normal life prevails for the next 6 months, that it'll be good for gold and silver, which is to say really good for the mining stocks. So a lot of these little junior miners that are just beaten down right now will really take off if that happens.
Do you have any price targets for gold and silver going into 2019?
Absolutely not. I think the tenor of the market should be strong and positive, but I have absolutely no idea, where it ends up when the run ends. There's the 1360 technical barrier. In other words, there's resistance there. Anytime it gets up to around 1360, it gets smacked back down, and it has had that happen 4 or 5 times since 2014. So I think it's easy to envision a run up to that level and another test of that resistance, and then we see what happens. If it breaks through, then there's a really nice run up into the 1600s probably for it. But it hasn't. The last 3 or 4 times it's been there, it's just gotten smacked back down. So I think there will be a lot of people betting on that happening again. So there will be a lot of selling pressure at 1350 and above that makes it hard to break through. And at the same time, there are a lot of macro reasons that it should break through. The world is getting crazier all the time out there, Jim. Not that it's not always crazy whenever you and I talk, but this whole emerging market thing is becoming a really extraordinary spectacle, because for a while there it was Venezuela was collapsing. Okay, we kind of expect a Latin American country to be collapsing on any given day or month or week. But then Argentina had a currency crisis. And then Turkey is imploding right now, and Brazil is hot on its heels, and Pakistan is looking pretty shaky too. So what has happened in the last few years to create the conditions for this is that a lot of emerging market countries have borrowed a lot of dollars, U.S. dollars, because the U.S. dollar was going down. So they decided to borrow dollars and then spend those dollars on infrastructure or whatever it was they intend to spend money on at any given time, with the intention of paying back those dollars later when the dollar was even lower. In other words, paying the loans back in cheaper dollars. Well, the dollar turned around and went up. So now all of those loans still have to be paid back, but in much more expensive dollars, which is a lot harder for these countries. And so you're seeing corporate bankruptcies, among the corporations that did some of the dollar borrowing. Currencies plunging because the governments are on the hook for a lot of those dollar-denominated debts. And so just general chaos now. Interest rates going up makes it even harder for people to generate the cash to pay off their dollars, and you've got kind of a death spiral going on with a lot of these countries. And the fact that it's 5 or 6 of them instead of 1 or 2 just makes the problem a lot worse because it's a lot more widespread. It affects many more Western banks who have lent money to these guys, which in turn may force Western governments to bail out some of their banks, which is what we tend to do when our banks get into trouble. Instead of letting them fail like we ought to, we step in and bail them out and teach them the lesson that they can do anything they want to and take any risk and don't have to worry. So they'll go right back out and lend money to people that they shouldn't lend money to.
Well, in Canada and the U.S., we have legislation now that has bail-ins. That is, they go and skim your bank account to look after their foreign debts.
Yeah, it's going to be interesting to see how that plays out because that's politically hard to do, right? If you're going to take money out of people's bank accounts, you lose those votes. There isn't a single person who is involved in a bail-in that will vote for you if you engineered the bail-in, right? So it depends on the size of the required bail-ins. I think beyond a certain point, they'll do bailouts where they'll just use taxpayer money that is made up out of thin air. They'll just give a loan guarantee to the bank or something like that because that's relatively painless. Bail-ins actually have individual losers. So while the impulse to do bail-ins is in some ways admirable because you're actually allocating real pain as a result of past mistakes, which is how capitalism has to work. You know, you got to have a downside to go with the upside or it doesn't make any sense. There has to be skin in the game. And bail-ins are an attempt to give us all a stake in the stability of the financial markets by putting our bank deposits at risk. But I don't think politicians will go through with it when the time comes. So I think it's bailouts all the way down, and until currencies don't work anymore. You know, we will just bail out everybody in sight until nobody will take the currency that we want to use for the bailouts. So that's the end game when fiat currencies don't work anymore. But there's no sign of that happening this week or this month or this year. So the emerging market crisis that is bubbling up is probably going to spread a bit more, but then the world's central banks will try to snuff it out. Then we'll see what happens. You know, we'll see if they succeed or not. But right now, it certainly looks like Turkey is functionally bankrupt. Venezuela is even further gone than that. Pakistan is opaque but in trouble. Brazil is just now at the beginning stages of what looks like a crisis with spiking interest rates and civil unrest, et cetera, et cetera. And Turkey is in the news. So they're the thing that we're going to be paying most attention to. But all these other guys are really equally dangerous. Although Turkey is kind of unique in a way because it's a NATO member. You know, it's part of our military alliance. And to have somebody in that position that owes a lot of dollars and have us not bail them out means we might be chasing them into the arms of China or Russia, which has geopolitical implications. So there's more to the Turkey saga than there is to, say, Brazil or Argentina. So, in other words, lots of stuff to pay attention to, lots of risks out there, as usual, but maybe a little more so than usual this week.
Well, Turkey's president has declared that he feels the U.S. has declared economic war by putting tariffs on their steel, and he's already holding talks with Russia to get closer to them.
Mm-hmm. Yep. So if we follow through on the stuff we've been doing, and they follow through on the stuff that they've been doing, it's possible that NATO fractures. Remember, the U.S. has military bases in Turkey. So it's not a simple thing for them to switch sides, and for them to consider doing it. It would be like Brexit, only with nuclear weapons involved. You know, so I don't know how it plays out, but it wouldn't be smooth or easy in any event.
We'll have more with John Rubino next on This Week in Money.
Haddock Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Haddock's management has extensive potash exploration and development experience in Thailand. Haddock will have marketing advantage compared to Western producers. Drill program commences this spring. Haddock trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, haddockventures.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with John Rubino. John, do housing bubbles exist around the world, and are some of them starting to pop?
They absolutely do exist around the world. Home prices in a lot of places are higher now than they were in 2006. And in a handful of places, they're higher, even adjusted for inflation, than in 2006. So we're back to bubble levels price-wise. The market dynamic is very different this time, though, because whereas in the past we were building millions of new houses and they were all being bought and people were flipping houses like crazy and buying multiple houses, now prices are going up because nobody wants to sell. There's no inventory on the market. And there is a debate about why that's the case. Some people say that, well, mortgage rates are going up and prices are really high. So if you sell your house, which has a cheap mortgage on it, and you try to buy a new house, it's not actually a good deal for you because you got to get a higher price mortgage and buy a really high priced house, and maybe you actually lose money on the deal. So a lot of people are just hunkering down and you know, they're locked in by the dynamic of the market to their existing house. Whatever the case it really is, though, there really isn't much inventory out there. So what comes on the market tends to sell fairly quickly at a fairly high price, but there's not a lot of deals being done relative to 2006, for instance. But price-wise, it is still absolutely, definitely a bubble. And in terms of affordability, houses in the U.S. especially are just out of reach of middle-class people in city after city after city. And obviously it's the same for you in Vancouver. You know, if you're a school teacher in Vancouver and you'd like to have a house, good luck. You know, you and 4 other families could move into a 2-bedroom house probably and pay for it. But otherwise, you don't get one. And that's the way it is in a lot of attractive cities, places where people want to move and where foreign capital wants to come in. Prices have just been bid up to the stratosphere, and they're out of reach of the regular people who live in those cities. That's historically a sign of a top. When affordability reaches the point where like half the people can't afford a house anymore, then the buyers are kind of, you know, they get even more scarce than they are, and things start to grind to a halt. And we're kind of seeing that in a lot of places now where sales are starting to slow down. Price increases are either slowing or reversing. For instance, Manhattan, condo prices are dropping now. And that's the case in several other cities in the U.S. I think London prices are down. And correct me if I'm wrong, Jim, but I think Toronto, Canada prices are falling too. So we're seeing the bubble top out, it looks like. And if interest rates go up a little more and we see a little bit more of the geopolitical stuff going on that involves, for instance, us making Chinese people not feel welcome anymore, so Chinese buyers evaporate and Russian buyers evaporate, we could easily see the real estate market turn down, and possibly in a big way, because when you get to the rarefied air that a lot of cities' home prices now occupy, there are air pockets under there. So you can see a 10 or 15 or 20% drop in home prices with no real substantive change in the local economy or anything. It's just that prices got ahead of themselves and then they go back down. Well, that's that's fine if you're an observer, but if you just bought at the high and you put down the 20% deposit and your house drops by 20%, you lost every penny you put into that house. Now that's the double-edged sword of financing stuff. When you have a leveraged asset, you make a lot when it goes up and you lose a lot when it goes down. So we're entering a time when more and more people are going to see the downside of this process at work.
How fast can housing prices collapse after a bubble bursts?
Well, in 2006, 2007, 2008, 2009, they peaked, and then they've just fell off the table. I think we saw 20 or 30% drop in most cities in the U.S. in 3 or 4 years. This time around, the bubble isn't as crazy. However, interest rates are going up, and prices are still extremely high. So it could happen fast. We could see a double-digit drop in a lot of major markets in the space of a year, which is a really big deal in real estate. They don't normally move in double-digit increments annually. But when you see them going up by double digits, which they have in the last couple of years in a lot of places, then you create the conditions in which they can easily go down by double digits. They can drop by 15% and still just be where they were in 2016. so it's not like they got cheap or anything. It's just that a lot of the froth got swept out of them.
When real estate markets collapse, do they take stock markets with them?
They can. There's a thing called the wealth effect, which basically is that when your stuff is going up in value, whether it's stocks or bonds or real estate, you feel smart and you feel rich. So you're more likely to max out that credit card on a nice vacation or a big screen TV or an SUV. The reverse, though, is also true. When your financial assets are going down in value, you feel stupid and poor, and you're less likely to spend money, and that slows the overall economy down. So when house prices drop, people spend less, corporations make less money, corporate profits drop, which leads stock prices down. That's one way the dynamic works. So we could easily see that this time because stocks in the U.S. are priced for perfection. Even relative to extremely high corporate earnings, price earnings multiples and price to sales multiples and any other price to whatever multiple you want to look at is bubbly. It's comparable to 2006 and even 2000 in some, even tech bubble levels in some measures, which means that we could see the same kind of 40, 50, 60% drop in stock prices that we saw in the last two crashes. And real estate could be one of the catalysts. So could the emerging markets. So could geopolitics. So could oil prices. Lots of things could happen that sets off a lot of other firecrackers that eventually scorches the stock market. And you don't know which direction it's coming from. Or, easily stocks could start to fall just because they're overvalued and pull down the rest of this stuff. So we don't know where it begins, and we don't know exactly what connects to what in the sequence that's coming. But there are a lot of dominoes out there that can easily be knocked over. So we'll just have to see what is first. Right now it looks like emerging markets are the big scary thing out there because they have a tendency when they blow up to blow up quickly. And they have a tendency when they blow up to take their neighbors with them. So we'll see what Turkey turns out to be, or we'll see what happens in Latin America with three potential, or actually not even potential anymore with Venezuela and Argentina. They both have already started to implode. So we'll see what happens to the neighbors of these guys, or to the creditors of these guys. If the banks blow up because the emerging markets blow up, that's a big deal because especially the European banks are really heavily into this. They've lent an awful lot of money to Latin America and to Asia and the Middle East. So we'll see what happens when their loan loss provisions really start to spike.
We'll have more with John Rubino when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with John Rubino. John, are banks constricting credit?
I don't get the sense that they are yet. It seems like, see, look at all this, the crazy stuff that's happening in the world, and then compare it to the U.S. economy, which is growing fairly steadily. We're seeing basically a normal economy. If you just put blinkers on and look at the U.S. economy and just tune out all the rest of the stuff that's going on in the world, you'd think, we're two-thirds of the way through an expansion. We're firing on all cylinders. Things are looking pretty good. The only tricky thing is maybe inflation is ticking up a little bit more quickly than we'd like it to, but otherwise, there are more job openings out there than there are jobs, or than there are people applying for the jobs. There are labor shortages in a whole bunch of places. A lot of companies are reporting record sales and in many cases record earnings. So it doesn't look like there's any kind of a credit crunch out there. It looks like the banks are willing to lend, and it looks like a fair number of people are willing to borrow. So that's not an issue yet. That could easily become an issue. Let interest rates go up a little bit more. Let credit card defaults spike. Let home prices drop. Let stock prices drop. Let the emerging markets continue to blow up. All of that could spook banks and cause them to tighten their lending standards, but they haven't done it yet.
Are consumers cutting back on spending?
Nah. Actually, I think the last few months have seen consumers spend more than they earned. In other words, the savings rate is still going down in the U.S., and consumer debt is still going up. That's a peak cycle thing. That's when we get really excited at the end of the process because we think it's going to go on forever, and we decide to finally bite the bullet and take that really nice vacation. And that is also an end of the cycle thing, when the savings rate really plunges. So, in other words, there's a lot of end of the cycle kinds of signs out there, and consumer debt is one of them. Bank lending is another, stock prices. It just goes on and on. You can't really find too many things that look like they're sustainable from here, because most things are stretched pretty thin historically.
Do you think interest rates will continue to rise?
Well, that's really one of the big questions, because inflation is starting to pick up. And it hasn't really manifested as wage inflation in the U.S. yet. We're still seeing wages grow at 2.5–3% a year, which is pretty much even with inflation. And it's not a sign of overheating. But we're seeing a lot of anecdotal evidence that there are there are worker shortages in different sectors. Like, we can't find truckers. Can't find enough truckers to do anything. There was just an article the other day about police dispatch lines, like the 911 lines in the U.S., can't find enough people. So they're going with no experience needed, where they used to demand fairly relevant experience for that kind of a job. And there are also stories of people doing away with drug tests, companies doing away with drug tests, because they can't find anybody to work for them that can pass a drug test, so they just stop testing. Other companies are recruiting at the local jails trying to find people who are going to get out pretty soon and see if they want to work, just because they can't find enough workers. Now, traditionally, that translates into higher wages, because one way you attract new workers if you're having trouble finding enough is to pay them more. So you steal other people's workers, basically. And when that happens, then you get wage inflation, and that spooks the Fed into raising interest rates more aggressively than they would otherwise. So let that dynamic play out a little more. Let the anecdotal labor shortages become systemic. In other words, let higher wages start to show up in the macro numbers, and then interest rates have to go up. And at that point, historically again, that's what chokes off recoveries and leads to recessions. So we've already started the process. We've raised interest rates several times in the U.S. We're not at zero anymore. We're heading higher. At the same time that the yield curve is starting to flatten and trend towards inverted. In other words, short-term rates might be higher than long-term rates if this current trend keeps up for another few months. And that's also a wild card. That's something that also points towards a recession coming in the not-too-distant future. Pretty much every time you get an inverted yield curve, you get a recession within the following year. So that also bears watching. In other words, Jim, there's a lot of stuff to watch right now. Many things are sending scary signals.
Are you watching currency trends?
Yeah, well, the strong dollar is a really dangerous currency trend because, first of all, that's not good for our trade. That slows down the U.S. economy because American companies can't sell things abroad as easily if they're pricing their stuff in more expensive dollars. But it also, as we talked about earlier, blows up those emerging markets who borrowed a lot of dollars. Currency trends right now are ominous for those reasons, because a strong dollar is dangerous at this point in financial history because of the decisions a lot of other people have made. And let the dollar go up because of geopolitics. For instance, when the world looks really, really scary, the dollar is a place where people from other countries hide out. They buy treasury bonds, or they move money to the U.S. and buy U.S. assets or whatever, because we're perceived to be safer than, for instance, Europe, which is right next to Africa and the Middle East, or the Middle East itself, or Asia, which has China in it, and China is deeply indebted and not the most stable neighbor to have. So people who make money and have capital that they can export, when they're nervous, they tend to export it to the U.S. That pushes up the value of the dollar and causes unintended consequences around the world. So to the extent that that dynamic continues for a while, lots of other bad things flow from it. So and any one of which could cause trouble beyond the borders of the country in which it's happening. So there's a lot that can go wrong.
Could President Trump's tariffs end the bull market in China, or is that bull market already over?
Oh, yeah, China's already in a bear market. Their stocks have tanked since Trump declared trade war. And China's currency is way down, too. They're responding to tariffs, which they can't counter because they don't import as much from the U.S. as we import from them. They're responding by devaluing their currency, allowing the yuan to fall versus the dollar. See, that makes their stuff cheaper, which offsets the tariffs that we're charging. So you've got a trade war morphing into a currency war with no real end in sight, although it could end pretty easily. I mean, a 4 o'clock in the morning tweet from Trump could end this whole thing, where he says, yeah, I talked to Premier Xi yesterday, and we worked it all out. He's going to come over to Mar-a-Lago and golf with me tomorrow, and I love China. We'll take those tariffs off as soon as we get done golfing, and it's over. That's the kind of thing that could easily happen. So the whole trade war thing is not something that has to have legs. It could have legs, could go on for a long time, or it could end right away. Whereas these currency fluctuations and emerging market dollar debt and related things, that's going to take a little bit longer to work out and going to be much harder to fix. And because of that, it's a bigger risk. Or at least it's more likely to be the catalyst that spins the global financial system out of control. We're all waiting for that thing that sets off the first explosion, that sets off the other explosions, and puts us back in 2008, 2009, or worse. They haven't come yet, but the emerging markets look like they're the leading candidate right now, and the dollar looks like the reason that the emerging markets are in so much trouble.
President Trump versus Prime Minister Trudeau, could the Canadian economy be in trouble because of that?
You guys are pretty resilient, and the whole U.S.-Canada thing has been mostly words, right? There's not a whole lot of substantive stuff happening so far, and hopefully there won't be, because, obviously, the U.S. has many problems, but Canada isn't really one of those problems. So it shouldn't be something that we escalate. And so if Trudeau keeps a cool head and doesn't do anything to spark an emotional response from Trump, we're probably okay, the U.S. and Canada. I really hope so. I hope the whole NAFTA thing, if it ends up being renegotiated, is done shortly on reasonable terms for everybody, and we can go back to having reasonably open borders. Much bigger problems are out there in the world, and the biggest, of course, is the amount of debt that we're all taking on. And Canada's not immune to that. You guys had a massive real estate bubble, and you've got high levels of consumer debt and high levels of government debt. So because of that, you're in the same boat as all the rest of the developing world, or the developed world, where you've taken on more debt than you can ever hope to pay off, and there's a consequence for that. You are going to suffer one way or another because of all the debt that you've taken on that you shouldn't have taken on, and you'll be in the in good company here with the U.S. and Germany and Japan and China and France and Italy, all the developed countries, or in China's case, the aggressively developing countries, who owe way too much. And there's really no way out of immense amounts of debt that's pain-free. You got to just choose one crisis over the others and take it. And I'm hoping that a currency reset is the one that we choose, because that's by far the least painful way to get out from under a mountain of debt. You just devalue your currency to some level that allows you to pay off your debts. In other words, if you owe $1 billion today, but you devalue your currency by 50%, in real terms you only owe $500 million, and maybe you can pay off $500 million where you can't pay $1 billion. If the whole world does that and then links their currencies to something stable like gold, which worked for 200 years during the classical gold standard, we had zero inflation and steady growth for 200 years. Or Milton Friedman's computer that only produces 1% more money each year, or, something like that. Some version of a monetary system that restrains government's ability to just create new currency out of thin air and borrow unlimited amounts of money. If we do that, we have this burst of inflation when we devalue our currencies. And then when we link our currencies to gold or whatever, we go forward with a sustainable, stable, sound monetary system. That would be terrible for the people who own a lot of fiat currency or financial instruments that depend on fiat currency. If you've got government bonds and we devalue the currency by 50%, then your bonds are worth half as much. So you lose a lot of wealth. But your house isn't blown up by an invading army, and you don't have hordes of unemployed people who don't have enough to eat, and they're looking for food wherever they, you don't have civil unrest, you don't have a civil war, you don't have all the other things that can flow from a horrible currency mismanagement like we've seen in the past. All that debt can give you a 1930-style depression. It can give you a Weimar Germany hyperinflation, which was followed by the election of Hitler. So we can avoid all that stuff with 1 year of extreme inflation and then a return to the gold standard or something. Now, will we do that? Probably not. Democracies require a crisis to take extreme action. because that's the only way you get a consensus, is when all the pain-free solutions have been proven to not work. Then you start looking at the harder solutions and figuring out which is least painful, and then maybe you've got a chance of doing something that's reasonable and sensible. We aren't there yet. We haven't had the crisis. So we probably have to have raging inflation and extreme instability in the financial markets, and et cetera, all the stuff that goes with gross financial mismanagement, before we have the conversation that goes something like, well, it looks like the problem is actually fiat currency. We never should have given the government an unlimited printing press. Okay, how do we fix that? How do we set up a monetary system that doesn't give the government the ability to create all this new money? Well, the gold standard worked. Let's try that again. We'll have that conversation at some point. But we'll have to be in extreme pain before we have that conversation, because nobody gets that yet. Governments don't want to do it because it means giving up power. Individuals don't want to do it because it's alien. We've lived our entire lives with fiat currency. We don't know any other way, and the idea of making a big change like that is terrifying, because it's a leap into the unknown, where, really, if you have any sense of history, it's just a return to what used to work before we screwed it up. But for most people, that's an education process. You have to see that what's working, or what used to work isn't working anymore, and then figure out why it didn't work, and then figure out what might work instead. That takes a long time. Although we're on internet time now, so it might be quicker than it would have been back in the days of newspapers and 50% illiteracy and stuff like that. So I don't know, but I think the important takeaway from all this is that things are going to get messier before they get better, and we don't know the details of the messiness. We don't know exactly the sequence of events which will lead from here to there, but it has to happen, because there's no other way. When you've borrowed this much money, you cannot avoid some kind of a crisis.
Trump offered Canada real free trade, fair trade with no tariffs, barriers, and subsidies. Should Trudeau have taken him up on that offer?
Oh, I'm not an expert on how trade works. Every country has its own needs in terms of trade. And so when we cut these free trade deals, quote-unquote free trade, we necessarily build in a lot of things that we think we need. And so you end up with a committee-created document that's not perfect and doesn't satisfy everybody, but that people are at least willing to sign. Just pure free trade, where all the tariffs are gone, is amazing in theory, and it's really, it's part of libertarian utopia. It's what, and I kind of class myself as a libertarian, it's what we would like to see. But it's hard to do, because some big industries will be hurt by that, inevitably. That's why you don't end up with perfectly free trade, because you have constituents in your country that really don't want to suffer under that kind of a regime. And you maybe can't get elected without their help, so you can't do that. So that could be part of the reason that Canada turned down the deal, or else it could be that they just didn't trust Trump. and they assumed that whatever he was offering actually had a bunch of loopholes in it that would come back to bite them, because one of his things, it seems, is writing contracts that contain fine print that benefits him at the expense of the counterparty. So it's completely possible that if he offered something, the first Canadian reaction was, okay, if he wants to do it, what's wrong with it? And they looked at it and found something. I don't know. But pure free trade is an ideal that we probably will never achieve, but it's a good thing to work towards. And hopefully that's what we're doing now, is moving down the road towards free movement of capital, relatively free movement of labor under some kind of a guest worker thing where our borders aren't open, but we do have lots of movement of people between one country and another who are documented and who stay for a certain time and go back after a certain time, et cetera, et cetera. So all of this stuff seems doable in theory. It's just hard to do in practice.
We hear President Trump is likely to change Dodd-Frank. What changes would you like to see to Dodd-Frank?
Oh, I would like to see a reimposition of Glass-Steagall. Dodd-Frank was a monstrosity. Thousands of pages of fine print that mostly hurt little banks and helped big banks, because that's how legislation works right now in the U.S. Glass-Steagall was a law that we passed after the Great Depression, which was in part caused by big banks doing horrific things, kind of like what they're doing today. Only what we're doing today is much worse than what the banks did back then. But they divided the banking world up into two things. One was a deposit-taking commercial bank that would have a government guarantee that said if the bank goes bust, the government will pay off the deposits. Okay, so depositors were protected, but those banks weren't allowed to take big risks. And the other group was the investment banks that were allowed to take any kind of risk they want to, but not with taxpayer money. If they go bust, they go bust. Nobody bails them out. They just stiff their stockholders, and those are really the only people who get hurt, stockholders and employees. In the 1990s, under the Clinton administration, although he was under pressure from Republicans to do this, and I favored it at the time, he got rid of Glass-Steagall and just allowed banks to do whatever they want to. And it turned out to be a horrendous mistake, because you got all these banks that are taking deposits that are guaranteed by the government, while at the same time they've got prop trading desks and investment bankers out there taking amazing risks with derivatives and you name the crazy financial instrument, and they're big time into them, and blowing up every once in a while. In 2008, 2009, we had to spend trillions of dollars to bail out these giant financial supermarkets that had gotten too deeply into derivatives and were going to die en masse if taxpayers didn't bail them out with trillions of dollars. Had Glass-Steagall still been in place, first of all, the real outrageous stuff never would have happened. And second of all, the stuff that did happen would have mostly impacted investment banks, and we could have let them just go bust. Merrill Lynch could have just ceased to exist. Goldman Sachs, who cares? Gone tomorrow. And society would have actually been better off for that process, because it would have taught everybody what not to do. But instead, because we'd allowed these big banks to combine and grow into systemically dangerous entities, we had to bail them out, or we thought we had to bail them out. I still don't think we did have to. I think, Jim, we could have let them all fail, and we would have been way better off today than we are, because, if Goldman Sachs ceased to exist, would that lower the number of factories in the world the next day? No. Same number of factories, same amount of farmland, same number of microchip factories, same number of hospitals. All the really important stuff would still be there. We would just have a lot of derivatives and derivative traders who aren't there anymore. And they could be driving Ubers or whatever, which would be an actual useful thing to do. So the world would be better off. So whatever we do with Dodd-Frank is completely irrelevant, unless we're going to go back to something that is similar to Glass-Steagall, where we break these big banks up and force them to live with the consequences of their actions.
By adding new governors to the board, is President Trump likely to make the Federal Reserve work for the people and the country?
No. The Fed in its current state is not capable of doing anything but working for the big banks. So that doesn't matter. See, all of this stuff is end of cycle, but end of super cycle activity. What the Fed does right now is just the last gasp of a failed institution. What the big banks do right now is just the late decadent stage of a financial bubble that started after World War II. Really got going in the 1970s when we broke the final link between the dollar and gold, and then shifted into absolute overdrive in the 1980s, 90s, and onward to today, when the government found out it can run any deficit it wants to. There's no political price to pay for it. We will vote for people who run up trillion-dollar deficits, and so now they just think they can do anything they want to. All of that has to end before any of this stuff matters. What the Fed does doesn't matter. What Goldman Sachs doesn't matter. What Congress doesn't matter. It's all just if somebody has lived an incredibly unhealthy life and they've got a stroke coming and heart failure and diabetes, and they decide they're going to start eating out less often and walking for 15 minutes a day, that's not going to save them. They're still going to die of one of those things. And that's the system today. It's beyond help and just has to collapse under its own weight. And then we start talking about which legislation will be beneficial and, what guy is the one we want in charge of this or that thing. Right now, it really doesn't matter.
Which sectors are you bullish on in the junior stocks?
Well, the precious metals miners, the really good juniors, are going to be spectacular if gold and silver do what it looks like they might do in the next 6 months. That is, if they start a run that has legs and seems to be lasting for more than a few months, then you'll see these little miners just take off. So the best quality junior gold and silver guys are the ones I like best.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, InsideTrackTrading.com President Eric Haddock, next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features to our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Eric Haddock, president at InsideTrack.com. He's speaking to us from the Chicago area. Eric, gold over the last 2 years has gone on an interesting ride, and you've noted the difference between gold stocks, and gold miners. Can you get into that for us?
Yeah, certainly. That is something that I try to stress to my readers every month, is that the overall outlook in gold has typically been better, whether that's less negative or more positive, depending on the part of the trend that we're in, but has been better than gold stocks. And some of that I trace back to a specific indicator that I watch. It's in this case, a monthly trend indicator. It's the same indicator I use on weekly and daily basis too. But going back to the rally in 2016 that you saw in all the metals and the indexes of gold stocks, it was intriguing to me that once we saw that peak in July and August of 2016, and then you saw a sell-off in the third quarter, during that sell-off, the XAU, the gold-silver index, gave a sell signal, a reversal signal that said that the previous peak should hold for quite some time, and that after we get a rebound, which we saw into early 2017, that then that index should move progressively lower and take out the December 2016 lows at some point before you could be in a position to mount anything more than a 1 or 2 month rally. So putting it another way, since I might be confusing the issue here, but it showed that the initial decline from August through December of 2016 in the XAU index was like an A-wave decline. You then saw a B wave bounce, and once the C wave took hold in February, March of 2017, the primary downside target for that monthly trend indicator was that the XAU had to get below its December 2016 low before it would even have fulfilled the minimum downside objective for that trend indicator, for the wave structure. But at the same time, gold and silver were showing that they could continue their rallies, or really corrective rallies on a multi-year basis, but that they continue set some new highs in 2017 before their next correction. And the reason I point that out is that even as we've come into the last few months, I've been reiterating this issue that the XAU still had to make it back down below that December 2016 low before it could be in a position to really put in a 6 to 12 month or longer bottom. In recent days, we have finally attained that minimum downside objective. And in the interim, back in May and June and July of 2017, and since then, I've talked about some overriding wave targets and range trading targets. It's a whole convergence of, or a higher synergy of downside targets, which said that move down in the XAU could carry it as low as 54 to 59 on that index. And so that's really what I'm focused on, even as gold has certainly dropped sharply, but it is holding above its December 2016 low. And so from a wave structure, that's just a significant point on kind of a 2 to 3 year trend basis. And I'd be happy to send out a couple of samples of recent reports to any of your listeners if they're interested that would explain some of this in more detail.
When you're taking a look at these different charts and how things have reacted, what's your future line on gold?
From a broader, like a 3 to 5 year perspective, it still is kind of the same thing, that we're in a corrective rally from the 2015 low, the late 2015 low. Corrective rallies are often a lot of volatility, a lot of sharp rallies met by equally sharp declines, and it's more of a sideways trading pattern than it is a strong up or down over a multi-year basis. Now, in between that, obviously you get strong rallies on a 1 to 2 month basis and sharp declines on a 1 to 2 month basis. So I think that gold and silver are still in this corrective rally pattern, and that it could extend into 2019, 2020. But from a more like a 6 to 12 month basis, I still am kind of viewing 2018 the same way, and that is that we would see the best chance for strong rallies were in the very beginning of the year and the very end of the year. That still is the case, that November, December is a time when you could see a strong rally, but that doesn't determine where that rally is going to emerge from and what happens in between. That's just a general cyclic wave and timing analysis. We got the first half of that in January of this year, carrying over from December of last year. And then I think that, like I said, November, December of this year, we'll see the timing for another one. But in between, you are just in a lot of broad sideways trading range with some sharp declines and some strong rallies in there. Right now, we're obviously in the very negative portion of that, but it's coming into a roughly 2.5 year cycle that I've talked about in the gold stocks that they have moved on a very consistent 30 to 34 month basis going back to even before their 2011 peak, but since then you saw that 2.5-year decline into mid-2013, then a 2.5-year cycle between the lows between mid-2013 and early 2016, and now we're coming into the next phase of that low-to-low cycle, with August being the ideal time, or the time with the most synergy of cycles all converging, for another significant bottom. So that's kind of factored in between this this outlook for 2018 in general of seeing the rallies at the beginning and end of the year, and this August cycle low could be setting the stage for that next up move.
We'll have more with Eric Haddock when This Week in Money returns.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange symbol CYP, the pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Eric Haddock. Eric, is there a cycle to housing in the U.S., and do you track it?
I do not track that. I'm sure there are probably some pretty consistent rhythms in housing that interplay with both inflationary cycles and interest rate cycles, but it's not something that I have put enough attention into to really comment intelligently on it.
Well, we do know housing's connected to interest rates and mortgage rates. What is going to happen there, and what has happened?
I think that bonds and notes, the inverse of interest rates, remain in the same structure that I've been describing for the last couple years, and that was that the bonds and notes would see a multi-year peak in 2016 and then work progressively lower into about the third quarter of 2019. So I'm still, most of the action since 2016 has corroborated that outlook. So I think that interest rates are going to continue to edge up higher into the second half of 2019. But you're obviously prone to some decent swings in there, and when you get all these issues like the various trade wars threatening to stifle some growth, at least on a limited basis, then traders start to react accordingly and push interest rates down a little bit, or at least start to minimize or reduce their expectations where future rate hikes are concerned. So that's where I think we're at right now, and I think that this rebound in bonds and notes, which took hold in May of this year, could stretch into September before they start to see a new leg down. So I do think that interest rates still have some upside to go, but it's going to be in kind of fits and starts where you see some bullish perception that starts to impact traders, and then more news to create a little anxiety and just kind of that ebb and flow with expectations.
What's the cycle for the equity markets right now?
They have been in what I expected to be a drawn-out topping phase. And coming into 2018, I thought that there were three time periods within the year when I thought you'd see the best chance for some intermediate peaks. That came into play in late January, early February, again in late June, early July, and then late November, early December. First one came into or reached fruition very clearly, saw a sharp sell-off, and in fact that sell-off in the Dow Industrials and some other stocks lasted into late March when a longer-term cycle low projected a 3 to 6 month bottom. When you look at the middle of those two expected peaks, we've seen several stocks and indices set their peaks in June, July, but then others continue to edge higher. So that one's not as consistent, although it doesn't alter what I'm looking for later in the year of a third peak. I think we're still going to see a correction before then, and then rally to a third peak for the year. And then as we get into 2019 is when I think that topping phase begins to roll over a bit more to the downside. I often use the analogy of a roller coaster where each of the cars on that roller coaster pass the summit at different times, and it's not till the last car reaches and passes the summit that the whole train can head down with any conviction. And I think that's the same way with equity markets and the different indexes and sectors within the markets. So I'm looking at 2019 as being that time when the market could sustain a bit more of downside movements, but between now and then, I think you're just going to continue to see these 1 to 3 month swings.
We'll have more with Eric Haddock next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Eric Haddock. Eric, copper has really taken a beating lately. What's the outlook for base metals?
I am still looking for copper to set a bottom in this August-September time frame. Late last year when it reached a major upside objective around 330. We had talked about it in a couple of interviews last year, and I had that in my publications repeated times, that was really appeared to be where a fifth wave rally should peak right around 330, and that then after that we should see a correction back down to about 245, 250. And we've seen about 75% of that, and I think that copper could still spike a bit lower in here. But I think that as long as that 245, 250 level holds, that copper would be in a position to mount a new 6 to 12 month rally. And that would fit with even a lot of the inflationary and even what we were just talking about with interest rates, the outlook into mid to late 2019. So I think that copper is approaching the time frame for a secondary bottom, and it's interesting to me that even a market like lumber just fulfilled a similar correction objective. Lumber has traded in these ranges for many years, and when it broke above 400, last year. It was expected to double that range and get up around 650. It did that, and once it signaled a top in there, I was looking for a drop back to that 400 level where it should find support. And lumber has just seen that recently, and I mentioned that because lumber and copper are often looked at as those forerunners of an uptick or a downturn in economic activity, and particularly housing. So even tying it back to that question of yours, that the outlook in copper and lumber certainly seem to be favoring another uptick in that type of economic activity over the next 6 to 12 months.
Crude oil, is it going to hang in there, or is it due for a dip?
It's definitely due for a correction. I thought it would be able to manage one more spike high in late August, but some of the price indicators are telling me that that's either going to take longer or is not going to materialize, because I've got a couple of key trend indicators that have been negative for the last couple weeks. But within that scenario, there's been an intermediate cycle that has governed crude over the last few months that ideally would put in a low this week, August 13th to the 17th. So that would still allow for that retest, rally back to the highs. But there's a few signals that I'm looking for to corroborate that. So overall answer to your question, yes, I think that it's getting very close to a bit larger correction, but I'm just not convinced yet that the final top for this 12 to 14 month advance is intact.
Eric, have you been tracking currencies?
Yes, I follow several currencies. Any in particular that you're thinking
the
about?
U.S. dollar, because the whole world watches the U.S. dollar, and of course we're interested in the Canadian dollar.
Actually, I'm putting together a report on the Canadian dollar that I hope to have out in the next few days or a week. But let me address the U.S. dollar first, that it is at a very decisive juncture where my work is concerned, that when it completed its sell-off in early 2018, it reached key downside objectives, fulfilled a lot of wave targets, so there were a lot of signs saying there that a bottom is intact. But the one thing from a 6 to 12 month perspective that I need to see, and this even kind of harkens back to our very early discussion about the XAU, but it's this monthly trend indicator that I use, and it takes a few months for it to be able to give a complete reversal signal. But in this case, I'm talking about the dollar potentially changing from a downtrend to an uptrend on the monthly trend indicator. And this month is the earliest that could be signaled in the dollar. So we're at a very pivotal level. When we broke above the 95 area last week, it signaled a new phase of strength and a breakout above some key resistance. And if this monthly trend indicator can turn up at the end of the month, that will confirm to me that that the dollar has entered a new 1 to 2 year advance, and that the low of earlier this year should hold through the next 1 to 2 years. Shifting gears to the Canadian dollar, September of this year, next month, is when I really have the strongest convergence of cycles coming together, and it's when I thought that the Canadian would pull back to a secondary low. I detailed back in 2015 why I thought that early 2016 would be a major bottom in the Canadian dollar. but I think that September could be, depending on a couple of specific indicators I need to see validate that, but that's the ideal time for me to see a secondary low and the Canadian dollar to start to turn positive, and I would be looking for a sequence of signals after that time frame to confirm to me that a bottom's intact.
What about emerging market currencies? Argentina's had a meltdown. Turkey's in trouble. Any chance of that spilling over?
The only thing that I've seen from that is the obvious result of money flowing into the dollar, and with some of those incidents, even the Japanese yen has been viewed as a little bit of a safe haven currency when the dollar's uncertain. But right now, I don't see a contagion effect, but you never know when it can spill into equity markets, into interest rates, and everything else. And sooner or later, there's going to be enough of those struggles that we're going to reach a tipping point.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Haddock, president of InsideTrack.com and also InsideTrackTrading.com. He was speaking to us from the Chicago area. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Eric Haddock, and thank you for listening. Also, a reminder, at the end of the show, we'll have a company showcase update from American Manganese CEO and President Larry Reaugh. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, you're off to the San Francisco Money Show. Will they be interested in cathode ray material? Well, not cathode ray, but cathode materials there, or batteries? Or is it just you get a good general sense of what's happening in the market and what kind of appetite there is for recycled goods?
Well, Jim, we have attended a lot of shows this year, and I would like to remind our listeners that this was at the invitation of battery shows themselves, recycling shows. We were invited, the company and myself were invited to speak at those shows and to present. And we've made a lot of inroads. A lot of battery companies and EV car manufacturers are certainly aware of us. And, we've had some of those shows, Jim, were included, speaker spots in which we didn't have to pay anything, so it was a real pat on the back to actually be recognized as a leader in the recycling of lithium-ion batteries area. And, we got lots of competition out there. People say, they make statements like we're going to use 100-year-old mining technology and we're going to recycle cathode materials. Well, that's kind of following what we've done. Certainly the technology started 100 years ago. But it's had tremendous changes in the last couple of decades, and I'm afraid that's not going to work to recycle batteries unless you're ahead of the curve on that. We're lucky. We're ahead of the curve on that. We've got a method that does work, and we've been happy to present at these. We've met some of the biggest battery manufacturers and EV cars and end users of the cathode materials. So it's been a lot of progress for the company, but we have to start attending shows where we are looking for investors. that's the money show in San Francisco, which I've been to several times, usually on gold companies or mining companies. And this is a kickoff for us to see what kind of attention we attract from investors there for the lithium-ion battery space. Now, there's been a lot of negativity about the cathode materials, specifically cobalt and lithium, which have been losing ground in price. But it's interesting to note that the cobalt price has been creeping back up. It's now at $64,500 a ton, up from $59,000 a week ago. And I don't see a huge move away from cobalt. It's necessary for the stability and longevity of the batteries, and I don't see a move away from that. Certainly the price spiked up because there was a perceived shortage of the material, and I say perceived because it turned out there was a surplus of it, and that drove the price down. So the cobalt, I think, is there's also the largest battery company in China that is moving to 811, and if you look at our business plan, you'll see that on 811 that we still have a potential profitable process there that's quite robust. So and I imagine that that the move will be down to less cobalt than we've seen in the past, but we're still going to be in the game, and we're still going to be in a very good profit position. So I just wanted to point that out. And the other thing that I just have to mention is really the whole battery thing took off when Elon Musk launched the Tesla and Tesla models, EV cars. Elon has really shone the light on all of the EV car production around the world. There's no doubt that he's the icon and the leader of this process, and it's a real shame to see that he's under attack. He's made some great accomplishments for the U.S. and employment in the U.S. and employment around the world, and being able to fulfill his promises. And that tweet, that burnt some of the short traders in the U.S., garnered more attention than all of his accomplishments, and that's a shame. And I think that people shouldn't forget that without him, I don't think the EV car manufacturing and production would be at the state it is today. So I just say that, people are always ready to jump on somebody when they're down, and I'm just saying that, I still respect and admire the man. He's the kind of guy that everybody should strive to be. So, Elon, I wish him the best of luck, and I know that it's got to be a very troubling time for him, and so we just send our goodwill on. So, Jim, I think that's about all that I wanted to talk about today. I mean, it's not like there's not changes every day that are happening out there, but I see that coming up in September, the news flow should start running again. And, in the meantime, we can put this hot, smoky summer behind us. It won't be long before we're starting to say, Jesus, it's cold. But it's the summer, and it's been a tough go for most of the companies out there. And, I see better times ahead.
Larry, for people who don't know about American Manganese and what you do, can you just give us a little thumbnail?
American Manganese is a critical metal company that has developed a process for the being able to take very low-grade deposits and make them economic in manganese. And utilizing that as a launching pad, we have developed a process for actually taking the cathode materials and getting 100% of the recovery on the bench scale tests. And we think that we have a leader. We've got a patent pending. It's already been published. It's moving faster than our original patent did, and so I think this is a company that provides a lot of opportunity. It could be, eventually be a multi-billion-dollar company because you're talking about a multi-billion-dollar industry. And we trade on the venture exchange, the TSX Venture Exchange, under the symbol AMY. We trade in the U.S. under the symbol AMYZF. And we trade in the Frankfurt Exchange in Germany under the symbol 2AM. We can be reached at 778-574-4444, or you can go to our site at AmericanManganeseInc.com, or you can email me direct at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 17th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.